Hello and welcome to the Business Standard Morning Show. I am Thirumoy Banerjee and here's a look at the stories for the day. In yet another blow to the Adani Group, MSCI has changed its weightings for some of the conglomerate stocks. The global index provider has cut its determined free float for 4 group companies, including flagship firm Adani Enterprises. Adani's troubles, brought on by allegations of fraud, have also led to doubts about India's growth story, which is being driven by investments in infrastructure. So, will the storm set off by Hindenburg Research hit the country's ambitious infra plans? Bhashwar Kumar brings you the answer.
Morgan Stanley Capital International has changed its weightings for a number of Adani Group stocks. The index provider took this step after reviewing how many shares could be freely traded. MSCI has cut its determined free float for Adani Enterprises, Adani Total Gas, Adani Transmission, and ACC. The cuts will come into effect at the end of February. As a result, passive funds that track the MSCI indices will have to prune their exposure to Adani stocks to realign with the revised composition of the index. The fresh blow comes in the wake of a report by US-based short seller Hindenburg Research that has accused the Adani Group of stock manipulation and improper use of offshore tax havens. The group has denied any wrongdoing. Adani's troubles have cast a shadow on the larger India story too. This is because the group operates some of India's largest ports and busiest airports. It also accounts for a third of the country's grain storage and operates a fifth of its power transmission lines. More importantly, it was expected to play a significant role in the country's ambitious infrastructure plans. But now, there is increasing scrutiny of Adani's finances by banks, and financial institutions are examining their exposure to the group. As a result, access to financing is set to become more challenging. So, the Adani Group may have to go slow on its planned investments, and that could be a problem. The Adani Group accounts for 3% of India's pipeline of major current and planned capital expenditure projects by value, and almost 10% of the newer projects that were announced in FY22. This includes both public and private projects. The Economist arrived at this finding based on CMIE data. Under the National Infrastructure Pipeline, the total capital expenditure in India during fiscals 2020 to 2025 is projected at $1.35 trillion. The private sector's share in NIP implementation will be 21%. The NIP is the centre's medium-term vision of infra development in India and includes central, state, and private sector projects. Last year, the Adani Group had announced at least $110 to $140 billion in investments across infrastructure sectors in the next 5 to 10 years. The investments were earmarked for green hydrogen, green energy, electricity transmission, roads, data centers, and airports. What is the overlap between Adani's planned infra investments and the NIP's headline number? It remains unclear, but Adani's expenditure projections do tell us about its importance in India's infrastructure ambitions. So, how will those ambitions be affected?
The investors in India's infrastructure come across a variety of institutions. They are the central government, state government, urban local bodies, private capital, domestic as well as foreign capital, and entrepreneurs and industrialists of various shades who all contribute to investing in one way or the other into different sectors of Indian infrastructure. So the current issue surrounding the Adani Group, I don't think in any way will impact the big India story and its ability to attract investments from all these different investors. But specifically for the Adani Group, I think that they have publicly stated that they are rejigging their capital raising and capital allocation plans. So I would expect a blip in their capex spend anywhere between 6 months to 12 months. But I would like to believe that after a year, their capital expenditure on the committed projects would be back to normal.
Adani is not India, And India is not Adani. I think the world needs to be clear on that. Yes, being among the largest conglomerates, they have been taking part in the major infra projects. But there is enough and more in the competition to take up the new projects. Nobody has questioned the viability of the group's businesses. The only issue could be the prospects of immediate fundraise. I think that could dim. So I don't see any issues with the existing projects they are handling since financial closure is in place. It could get a bit slow for them in terms of new projects. Some of the bids they have won recently could come under scrutiny. But to say that India's infrastructure growth will slow down due to the Hindenburg Adani episode could be a bit far-fetched, especially when the overall capex planned in the recent union budget is at a record high.
The sentiment on India's infra plans is bullish.
India plans to spend US dollars 1.4 trillion under the Gati Shakti program, which includes major projects such as DMIC, bullet train, Sagarmala projects, smart cities, metro corridors, and new airports. In the Union Budget 2023-24 as well, the government's focus was clearly on infrastructure upgrade, with capital investment outlay increased cheaply for the third year in a row by 33% to INR 10 lakh crore. All in all, with the nation's massive focus on infrastructure projects, the economy at large and the real estate sector in specific is likely to benefit.
If the Adani Group's appetite for ambitious infra projects is reduced in the wake of the present crisis, other players will eventually rise to the occasion and fill the gap, even if it takes them about a year to do so.
A 33% hike in capital expenditure outlay for FY24 attests to the government's commitment towards building better roads, highways, ports, and other critical infrastructure. And from the proposed 10 lakh crore capex budget, railways got the lion's share. But despite the good budgetary allocations in the past, the national transporter's operating ratio is still hovering close to 100. So how best can the railways allocate its budgetary outlay? Debargya Sanyal's report has the answer.
The Union Budget for 2023-24 has extended a bonanza for the Indian Railways, a budgetary support of 2.45 trillion rupees. It is nearly a quarter of the centre's total capital expenditure outlay of 10 trillion rupees. Increasing by 50% from the 2022-23 revised estimate of 1.6 trillion rupees, it is the highest ever outlay in the history of railways. Budget allocations to the railways have been surging consistently for the past fiscals, and yet several crucial challenges demand a judicial allocation of these funds. The railways' extra budgetary resources have fallen from 81,700 crore rupees in 2022-23 to the budget estimate of 17,000 crore rupees for FY 23-24, which is a sharp dip of 79%. While its projected appropriation to pension funds marks an almost 25% growth, its expenses for current employees will be growing only by 4%. Experts believe judiciously allocating the increased outlay will be one of the biggest challenges for the railways.
See, last year's capex was 140,000 crore, and this year it is 100,000 crores more. And eventually, what railways is dealing is infrastructure, and a budget period is only 12 months. So to spend this 100,000 crores in 12 months, I think it itself is a tall task. It is doable. The biggest challenge is speedy execution of whatever is committed.
One avenue for channeling the massive outlay will be the Ministry of Railways Mission 3000 MT, which aims to achieve a total freight volume of 3,000 million tons by 2027. The Indian Railways earnings from freight loading in the first 9 months of the financial year 2022-23 too surpassed last year's earnings in the same period. Railways earned more than 1.2 trillion rupees during the April-December period of the financial year 2022-23, an increase of 16% from the same period in FY22. Freight loading isn't the only focus area for the Railway Ministry. Infrastructure projects would be a major magnet for railway spending. The Finance Minister had said in her budget, 100 critical transport infrastructure projects for last and first mile connectivity for ports, coal, steel, fertilizer and food grain sectors have been identified. They will be taken up on priority with investment of 75,000 crore rupees, including 15,000 crore from private sources. In 2023, the thrust will be on increasing the number of Vande Bharat trains, introducing hydrogen-powered trains, laying new tracks, and completing the Ahmedabad-Mumbai bullet train project.
First of all, anyway, the carbon footprint of railways is lower than roads. And with the focus on hydrogen-powered trains and other technology interventions, I am sure even in terms of the climate impact, it will become very critical. So I think while there has been a significant impact or increase in outlay, it needs to be channelized in the right priority areas even within railways.
Also on the cards are new dedicated freight corridors, high-speed passenger corridors, and multi-tracking and signalling upgrades of congested routes. Experts suggest that the money must be dedicated to upgrading the fixed infrastructure in terms of signalling, electrification, tracks, and so on. Passenger experience in terms of faster and more accessible ticketing, station maintenance, and cleanliness, etc., will also be areas of possible updates. A lion's share of the railway's total expenditure is directed towards its employees, both past and present. In 2022-23, according to revised estimates, railways spent more than 1.63 trillion rupees on payments, allowances, and pensions. This is nearly one-third of its total expenditure of 5.19 trillion rupees. Experts highlight the need to leverage its current workforce and incentivize higher returns.
I don't think it's to do with additional recruitment. It's to do with average increases in compensation costs which have happened over the years. And I think that the issue really is how to leverage this workforce and generate higher returns, higher revenues, because a lot of it has to do with capacity building, training, redeployment, identification of new avenues.
At the heart of a judicial allocation of budgetary outlays, however, is the railway's overall operating ratio, or the proportionate expenditure the railways incur to earn every 100 rupees. This is expected to improve to 98.22% in the current fiscal. The ratio was at 107% in FY 2021-22. Higher operational ratios often indicate inefficient usage of revenues. However, despite a sharp rise in capital expenditure by the railways over the last few years, the national transporters' operating ratio has been projected to worsen, rising to 98.45% next year. Maintaining a healthy operating ratio, therefore, will be another major challenge for the railways, experts believe.
Over the last couple of decades, freight has been cross-subsidizing the passenger part of it. And if there is going to be a decline in the freight, then the operating ratio goes for a toss. So maintaining a healthy operating ratio, bringing in the shift from road to rail, that will be the second part of it. And also they have lost out to the air mode of transport in the second class AC and the third AC. All of this needs to be plugged in.
Guha also believes the funds could be channeled towards a few softer sectors within the railways.
It needs to overcome certain other constraints as well, in terms of first and last mile infrastructure, in terms of new technology. But the softer issues will also need to be addressed so that railways can effectively compete with roads. And much of this will require collaboration with a larger ecosystem of transporters. So, for example, point-to-point delivery. So there needs to be alliances, there needs to be collaborations, there needs to be transshipment facilities. Then the issues around focusing on some of the economic corridors. So in terms of goods traffic and freight requirements. Those are the areas to focus on.
Experts, therefore, are clear that the additional trillion rupees allocation in this budget is in itself a major challenge when it comes to clearly defining allocation goals for the railways. First, stabilizing and then driving down the operational ratios should be a major priority. The outlay should be a catalyst for fast-tracking new technologies, improving online and offline consumer experience, and increasing the modal share of the railways across sectors.
Meanwhile, for corporate India, the pace of earnings growth continued to slow down in the December quarter as high interest rates increased the costs. Besides, persistent weakness in the rural economy coupled with plateauing urban discretionary spends ate into the profitability. In our next report, Nikita Vashisht explains the key risks that India Inc. may see in the upcoming quarters. Coming on the heels of geopolitical uncertainties, the December quarter earnings were keenly awaited by investors to gauge demand trends amid fears of a slowdown. However, what swayed Q3 earnings was neither significant degrowth in demand nor input costs, but finance cost. A business standard analysis shows that the combined interest expenses of 888 listed companies, excluding firms in the banking, financial services and insurance space, rose nearly 31% year-on-year. This was the fastest pace of growth in at least 17 quarters. As a result, the combined net profit of these companies declined 13% YOY to 1.21 trillion rupees from around 1.4 trillion rupees a year ago.
The operating margins continue to remain stressed for most of the companies, except for IT and BFSI. Dent in operating margins have clearly seen, which has resulted in slow earnings growth. Also, hikes in interest rate has slowed down the demand as well as consumer spending and increased interest costs.
Including financials, net profit of over 1600 companies listed on the BSE stood at 2.45 trillion rupees at the end of Q3 FY23. This is higher by around 5% on a yearly basis and 18% sequentially. Sales meanwhile rose 19% YOY and less than 3% quarter-on-quarter to 27.22 trillion rupees. As per Motilal Oswal Financial Services, 29 companies saw upgrades while 41 companies saw downgrades of more than 3% each. This has resulted in an adverse upgrade to downgrade ratio for FY24. Given this, Nitin Bhasin of Ambit Institutional Equities believes the earnings deceleration can be reversed if India sees more jobs in the rural economy.
I think it's largely the banks which are the best performing sector in the entire quarter. Consumption, mostly in rural as well as in the discretionary, is suffering. There were some inflationary advantages of the commodity prices coming down for most of the companies or sectors which held the margins, but otherwise revenue growth was a little tepid. Unless and until job creation and the rural economy does not recover materially, we can't see a material change in the trajectory to the earnings deceleration which we are witnessing.
He says this will hinge on inflation trajectory and sustainability of domestic demand.
There isn't much of an improvement in the rural economy. Continued pressure emerging in the urban consumption in the discretionary, and perhaps that is also visible in the decelerating or not much increase in the residential real estate. These are the three things that one needs to watch out for over the next 2 or 3 quarters. Whilst we see that inflation pressures have receded, one needs to be watchful about how the inflation perhaps in a few products such as metals, etc., comes back and impacts the margins. But for right now, it isn't the input cost that's a pressure. But moreover, as the bank's cost of funding rises, that could be the other thing to watch out for, a healthy sector which has been posting some very good numbers.
Solanki of Anand Rathi further adds that high interest rates could delay private capex, delaying capacity additions and thus affecting the production capacity of India Inc. This week, retail and wholesale inflation data for India and the US, along with other global cues and stock-specific action will guide the markets. The rout in Adani Group stocks, which began January 25th after a release of a Wall Street short sellers report, was halted for a brief 2-day period last week. It coincided with the conglomerate's move to release pledged shares worth $1.11 billion in its 3 companies about 9 months ahead of the maturity. It instilled some confidence in the investors before another news dented it. But what is pledging of stocks? Rex Kano helps us understand.
To reinstate investor confidence in his company, Gautam Adani had prepaid loans worth $1.11 billion on February 6th to release pledged shares in his 3 key companies: Adani Green Energy, Adani Ports, and Adani Transmission. Market analysts said that the move released some pressure from the group's share prices in case they were to fall further because there will not be any top-up demand from the lenders. To understand that better, let's first know more about share pledge. In simple terms, share pledge means borrowing funds in lien of shares as collateral. This is done by both investors and promoters of the company. Just like individuals use house or gold as collateral, equity shares too can be pledged with the bank for availing a loan. Investors, even though they hold an asset in the form of shares, their funds are locked and cannot be used for new trades. Hence, they can pledge shares with the broker and avail margin for trading. In the case of promoters, other than raising funds by way of issuing fresh equity or debt, they can pledge existing shares and raise funds immediately. Promoters can possibly pledge shares to meet working capital requirements, funding other ventures, or fulfill debt obligations. For instance, the Adani Group was to pay part debt worth 4,165 crore rupees from its planned 20,000 crore rupees FPO. But here comes the tricky part. Once shares are pledged, they act as a lien and it gives the lender the right to recover dues in case of a default. The default could be on 2 counts. 1, the inability of the promoters to pay dues on time, or 2, significant value erosion in the share prices, thus indirectly impacting the pledge against the loan value. For example, say a promoter pledged shares worth 100 crore rupees for 90 crore rupees loan. In case the share valuation dropped below the outstanding amount during its tenure, the loan becomes a risky proposition for the lender. So in such case, the lender can ask the borrower to increase the lien by way of pledging additional shares or alternatively offload some percentage of the pledged shares in the open market to recover dues. In case pledged shares are offloaded in the open market, it eventually results in decrease in promoter holding and additional free float in the market. Also, companies with high pledging tend to exhibit higher volatility. Hence, investors must keep a close watch on promoters' holdings.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Adani Group has, meanwhile, hired US legal firm Wachtell to take on the short seller's Hindenburg research. It is one of the most expensive law firms in the United States, which is known for taking on complex corporate government cases. That's all for today. For more news and analysis, please log in to business-standard.com.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.